Good evening. You've joined us right here on the India Development Debate. I'm Taneia Bhardwaj coming to you live from our Mumbai studios, and we're going to talk about the crude comfort that's come to be for the Modi government. Brent prices today have slid to $62.50 a barrel from a record high of $86.70 a barrel in early October, giving a big breather to the centre on the fiscal front. Now, visibly relieved, top officials at North Block say that the oil meltdown will help rein in the current account deficit. The fall in oil prices has, of course, breathed some life, looks like, into the Indian rupee as well. It's been on a free fall in the recent months. Coming in the middle of election season, lower fuel prices could lift the prospects of the ruling dispensation, that's the BJP, in state polls and the general election as well. But despite the breather on the macro front, the market, for now, not in a mood to celebrate. Experts say investors are worried about the impending global slowdown, which in turn could put pressure on oil prices. The oil meltdown and what it really means for the economy and the market is what we're going to try and discuss over the next 1 hour right here on the India Development Debate. And for that, we've got a stellar lineup for you. Joining in on the show, Anant Narayan, who's a money market expert. We've got former Petroleum Secretary, Mr. Saurabh Chandra, who's here with us as well. Economist and former Union Minister Y.K. Alag joins us. So does Senior Energy Analyst at Interfax Global Energy, Abhishek Kumar. And ET Now's Consulting Editor, Maithili Pusnurmat, is here with us as well. A big good evening to all of you, and thank you so much for sparing the time. Maithili, I'm going to begin by asking you, a week ago when Brent crude tested $65 a barrel, I remember Uday Kotak put out a tweet saying the heavens seem to be smiling on India. That smile seems to have only sort of broadened today. But just how much comfort should we be drawing from this crude crash?
Well, with crude oil, one can never say. It's almost like the Sensex has been so volatile, but to the extent that it has fallen, and there are indications that it will stay low for at least for some time to come, all one can say that this is a very lucky government, because just when there were serious worries on the current account deficit, on the fiscal deficit, and on growth in general, I think suddenly things have changed. And it does seem as if things are really going the government's way, particularly when you've got elections staring us in the face. This has really been a huge bonanza for the government, because suddenly all the storm clouds that are gathering ahead seem to have receded. But having said that, one can never say with crude oil, because it is one commodity on which geopolitical forces have a huge impact. But for now, we can certainly breathe much easier, and that is certainly very good news for the Indian economy.
Lady Luck is shining on us, and Anant, clearly the government seems to be, exuding that kind of confidence as well, sending out signs that this weakness is crude is going to help it rein in the current account deficit at below 2.5% this fiscal. Are we getting ahead of ourselves, especially since Maithili was saying that there's just so much at play and it's all unraveling so quickly?
It is a welcome relief for us, Tanya, no question.
All right, Anant, I think we've got you on a bad line, so we're just going to try and fix that. Mr. Chandra, let me just put forth, that exact question to you. Is the volatility something that the government needs to be wary about?
The only certainty in the world of crude oil is uncertainty. And the way things look, perhaps OPEC Plus is going to cut production. When this deal with Iran was on the anvil, Saudi Arabia prices would be around $80 per barrel. That is where their budget balances. They've been shocked by the sanctions relaxation that has taken place. And the chances are that Saudi Arabia, maybe Russia, they will cut back production and the prices may go up. It's very difficult to say by how much, but the possibility is that production cuts may be coming within a month.
Production cuts might be coming, and possibly even as early as next month when we, see that OPEC meeting take place. But Abhishek, let me ask you about something that just, hit my Twitter timeline about 2 hours ago, and that's Donald Trump thanking Saudi Arabia for the low oil prices on Twitter. He's gone on to then say, let's go lower. This is a greeting that's coming a day after, you had Trump making it very clear that he won't let the murder of Jamal Khashoggi ruin relations with the kingdom. Just wondering, from the Saudis' point of view, how much of a slippery slope is this going to be? Because on one hand, you've got the Trump administration that's pushing for lower oil prices. On the other hand, the Saudi economy also needs higher revenues.
Yes, like it's quite a lot of politics involved over here. And if you're looking from President Trump's point of view, then the lower the prices get, the better it is for consumers. However, from producers' point of view, that's not such a good news. So it is quite a slippery slope for Saudi Arabia dealing any such a deal with the US.
Abhishek, would you hazard a guess at all and which way we're headed? I know it's very perplexing to sort of call a bottom on oil, but today you had folks saying that 60 is pretty much a floor for it. Is that the way you're looking at things as well?
Where we find ourselves at the moment, it's quite a volatile market, and we need to look at the reasons for why prices have gone down recently. So the first reason I would say is the rising output from the United States and Russia. Those are touching all-time high. So that's weighing on oil prices globally. The second reason I would say are the exemptions. Those are given from the US sanctions on Iran to some of the key consumers of Iranian oil. And that exemption will last for, say, about 6 months. So that's another factor which is weighing on oil prices. And then certainly worries about the global economic growth prospects. So that's another thing that has hit oil prices recently. And finally, one point I would like to raise is the sell-off in equities that we observed, for example, yesterday. So that's also not good for oil prices. So those are the key factors. Those are weighing on oil prices.
Of course, we're going to try and touch upon all of those in the next 60 odd minutes. But Mr. Alag, let me ask you, since April this year, the government has come under a fair amount of fire for not doing enough to bring down retail fuel prices. You've seen the government and OMCs, of course, absorb something like 2 rupees 50 paise, and then, states sort of matching that up in equal measure. Do you think that the government might just be tempted to dole out, some of those gains that it makes through easing crude, since we are headed into state elections and, of course, the big one in 2019?
I think they probably do that anyway. The demand for the domestic demand for oil products is fairly inelastic to prices. Our consumption, automobile growth is quite high. So, and again, on the price front, normally, since demand is inelastic, prices, these things tend to be pass-throughs if prices are rising. But when prices fall, normally they are sticky because corporates generally try to not pass on the fall in energy prices to the consumer. So I don't think there's going to be a major impact on the general price level. There will be the impact on foreign exchange. I think that's what the earlier speakers have been saying, and that's obvious because that's almost a mechanical effect. But I don't think there's going to be a major impact on prices. And normally the demand for oil is fairly price inelastic. Now, whether it is price inelastic to this extent of a big fall, as an economist, one would worry because we've not seen such wild falls in such a brief period. There might be the other effect which previous speakers have called about. The economists talk about ratchet effects, and if prices have fallen so low, then in the future the only thing that you expect is that they'll go up. And so that is not a very happy sign, in the sense that what it says really is that you've absorbed all the gains. And to the extent that I understand it, whatever few corporates I'm involved with, they generally are tending to hedge Again, I mean, they went hedging for some time because there seemed to be a fall, but now I think most of them are tending to hedge and of course enter into contracts also. I don't know if that answers your question.
Right. Yes. Yes, Mr. Allen. We've got Anand back with us, and Anand, I don't know how much of what the others were saying you got, but I think we all agree that the volatility in prices that we've seen in crude is rather perplexing. I mean, in October, Brent was around $86 a barrel. There was talk about how it could even be headed to 100. A month later, here we are. So I was asking you about, where do you see oil prices going from here on, and whether it's perhaps a little too early for the government to be drawing comfort from that.
Well, Taneia, it's clearly welcome news for us. As a country, we import about 1.2 billion barrels every year. So, we've seen a $20 reduction in oil prices. That's about $24–25 billion of current account deficits saved. But, as you rightly point out, there are a whole series of exogenous and external factors which we have very little control on. Oil price is clearly one of them. The trade war or what comes of it between US and China is another. What happens to US yields and Federal Reserve rate hikes is another. Geopolitics is still another question mark. All this is frankly out of syllabus as far as we are concerned as a country. I think the best we can do, while hope and prayer are our national strength, they can't form a core of our economic policy. What we have to look at is what is in our control. Now, we would make a mistake, if we take refuge in this bonanza that we've got on lower oil prices and take the eyes off the ball as far as our core problems are concerned. We still have an issue when it comes to the external sector. Our exports aren't doing well. Look at ready-made garments, look at gems and jewelry. They are struggling. We are still importing a lot of manufactured products which we should be producing domestically. Electronics, plastics, we have a trade deficit of over $60 billion with China, which makes no sense. So all those issues still need to be addressed. Our terms of trade are still adverse, even with oil prices coming down. And using the fact that we've got some time with this oil bonanza, we have to address those core issues going forward. It would be a serious mistake if we just let this rising tide of low oil prices lift us and not address the real issues that we have.
That's a point well taken. Madly, softer oil prices have also helped the rupee regain a fair amount of lost ground. Of course, you could add to that the uneasy truce that's come about in the last couple of days between the government and the RBI, which seems to be boding well so far for the currency market. Given that, what's the outlook for the currency?
Well, Taneia, there's one uncertainty over there, and that is that the Fed is almost certain to raise interest rates in its meeting in early December. And when that happens, we will see some flight of capital out of the country. So one's not very sure that the present stability and the strengthening of the rupee that we've seen is here to stay. Certainly, we will not have the kind of weakening that we saw earlier when crude prices were rising very high. And remember also that when crude prices fall, there is one cloud in the otherwise silver lining. And that is that India is the 6th largest exporter of petroleum products. So to that extent, at a time that Anand mentioned, our exports are already not doing well. A fall in crude prices also affects our export of oil products. And then that does depress our export performance even further. So not everything is hunky-dory when oil prices fall. There is this minor problem here. And of course, we'll have the Fed hike in December, in which time we will see capital flow out of the country, because the interest differential will increase, because there's just no way that the Reserve Bank can hike interest rates given the fact that our CPI, the consumer price inflation, is at an almost all-time low of just 3.3%. So there are these two little, points of worry, even as we see an otherwise rosy scenario, presuming the scenario is here to stay, which of course is a big if when it comes to global prices of oil.
Anand, let me just come back to you and ask you that, do you suspect that's the mood that's likely to prevail? Because, today you had, data about how foreign portfolio investors kept rushing to the exits even in the September quarter. We've seen outflows of, to the tune of $900 million. But their main worry has been a widening current account deficit and a weakening rupee, both of which seemingly now are under control. Is there a chance that we're going to see that sentiment reverse?
Look, Taneia, like I mentioned, we still have core issues on the external front. It could improve if oil comes down further. But even with this improvement in oil prices, we likely have a current account deficit this year of $65 to $70 billion. Now, even if you get $35 billion of FDI, we are still looking at a core deficit of $35 billion, which needs to be made up by us borrowing money from elsewhere. That's not a happy situation to be in. Now, in addition to this flow problem, we also have a stock problem. Over the last 4 years, because of stable macros, a solid government, and the fact that oil prices were low before this year, there's been a steady inflow of money coming into the country, seeking the high real interest rates that we had in this country, whether it's portfolio flows in debt, whether it's exporters selling, importers not buying, people borrowing in dollars and not hedging, and so on and so forth. Even today, there is an overhang of unhedged exposure sitting in this country. So, given both of this problem, the flow as well as the stock problem, we have to be cautious. While we celebrate the fact that oil prices have come down, while we celebrate the fact that RBI still has ample reserves to handle any contingency that comes up, and the fact that rupee is already depreciated by 10-12% this year, all this is good news, but we have to understand the core issues remain. And as I said earlier, we have to take this opportunity and the breathing space we've got to address issues on exports, to improve our manufacturing and reduce our imports, and of course, look at the other weaknesses that we have around the health of our financial services ecosystem, around our fiscal deficit, the quality of our fiscal deficit, and so on and so forth. There is plenty of work to be done. I'll also put you a last spin. Look, the one result of this US-China trade war is that US companies are trying to move out of China and set up supply chains elsewhere. Now, India, frankly, should be rushing in and taking advantage of this. We have, still have cheap labor. We still have a fantastic workforce, with a bit of infrastructure. There is no reason that a lot of those supply chains should not move into India. Unfortunately, the larger companies are still looking at Vietnam, Philippines, even Bangladesh, but not really completely convinced about India. So here is an opportunity for us to actually not just survive, but thrive and improve our position on the external front alongside. So a lot of work to be done. I think, again, I would only reiterate, we can't rest on the fact that oil prices have come down. We have to grab this opportunity and actually make something out of it and address the core issues that we're facing.
Mr. Chandra, let me ask you, just how big an advantage do you think it's going to be for India should oil prices continue to sort of hover around $63 to $65? I'm sure you would agree that, the uncertainty that everybody on the panel seems to agree upon will also somewhere muddy waters for the government's math, isn't it?
Oil prices impact the current account deficit, they impact the fiscal deficit, they impact inflation, they also impact the value of the currency. So if the prices remain low, all four of them are going to benefit. Now, it's very simply, what happens with oil prices is that if there is volatility, then speculators come into the market. Now, it's a mix of geopolitics and speculation which hits the oil prices in the short run. But we have a huge trade deficit. And as one of my co-panelists mentioned, we should have used this opportunity to boost manufacturing in the country. Manufacturing required factor reforms. Land, labor, capital, and each one of them doesn't seem to have made too much headway. We have problems with infrastructure, we have problems with electricity, we have low capacity utilization, while large areas of the country are still running on diesel gensets. Now that is one low-hanging fruit. If we get captive power off, we can cut down the demand for diesel. Similarly, we have to manage the demand for oil. We have to reduce it. There are ways to do it. There are low-hanging fruits. At the same time, we have to increase the domestic production. Actually, it has been falling in the last 4 years. Action has to be taken to ensure that production is what we concentrated on and not on government take. Once the production goes up within the country, and that is the only way to get energy security, is to produce within the boundaries of the country.
buying assets abroad doesn't add to energy security. We have to reduce our import dependence, which is going up, which has assumed dangerous levels. We have to become energy independent to some extent on the oil front. Otherwise, the way things are, there'll be volatility, prices would go up and down. Oil is the most politicized commodity in the world. There is very little we can do about its prices, and the trade deficit and the current account deficit would reach levels where the inflows on the capital account would not be able to match this deficit.
Okay. Mr. Alag, let's bring the focus back to where you likely see, the economy headed, at least in the next, say, 6 months or so. Do you believe the windfall from crude is going to be sufficient to contain the twin deficits? I mean, take, for instance, GST collections, they're way off the mark. Divestment target of 80,000 crore rupees this year is looking like a very tall task. How do you suppose the government's going to be able to, pull it through?
I think the short-run effect will be there. There's no question about that. What is going to happen after 3 or 4 months? Well, that's with the gods, both on the exchange effect as well as the domestic budget. I think the more important question really is, listen, we are a very energy short country. We are one of the major countries of the world which has hardly any oil. We depend very highly on imports. And what we need is a policy where we are able to use more of our own domestic sources of energy. Now that is where all talk of energy policy, because we have abolished the Planning Commission, there is nothing like that. So which means that if the prices fall, we pass them on, rather than having a deliberate policy of keeping oil prices high. Now, I think basically that alternative fuels, yes, of course, to the extent that you have sustainable, renewable energy, that's good, but that's subject to certain limits. So beyond that, it's coal. And coal, we can do it in many different ways, and we are not doing it because it's largely used in the public sector for power plants, and also the transportation link with the private sector industries like cement and so on. Again, there we have put in very little in the infrastructure. So we have a lot of coal being lugged on trucks. We have a totally wasteful use of energy in the country. These things have been extensively studied. That they have very important macro effects in 1 or 2 years is well known, and they have even short-run effects. But we are not looking into those issues at all. And I think this respite that we have got should give us the push to push in that direction. Otherwise, the short-run effects are good, and I think we should rejoice on that.
Abhishek, let's bring the focus back to oil prices. And, I think there is a large consensus that pressure is building on OPEC to shore up prices. Word has it that you could even expect production cuts of something like 1 million barrels a day next month. What's your sense? What are we going to see in, Vienna come next month?
That's a very good question, and it's very difficult to speculate what the OPEC is going to do. However, the general mood among OPEC member countries is to cut production, is to boost prices. But the question is, over here we are also talking about the OPEC plus agreement. So whether countries beyond OPEC, whether they agree to cut production or not, that's a big question. So if you are looking at countries like Russia, they may not be too happy cutting production at this point. They may think that what they are already cutting is quite substantial. So it will be a tough sell by countries like Saudi Arabia in the upcoming meeting. But looking at the mood within the OPEC, that is getting quite strong.
Maitli, a slowdown in global growth, partly on account of what's likely going to happen as far as US-China trade war, is what's really depressing global demand for crude. to that extent, the prospects for the global economy are rather dim. And while we can find crude comfort for our own economy, if you were to sort of take a macro view, we can't be an outlier, can we?
Oh, absolutely not, because we are far too integrated. The Indian economy is far too integrated with the global economy. Globalization is definitely here to stay. So, whatever happens in the global economy is going to impact us. And if there is a slowdown, it's going to hit us even more in the part of the economy that we need the most in terms of export demand. Because the fact is that the rupee is the exchange rate. In fact, a strengthening rupee doesn't do very much for our exports. If along with that we also have global demand for our exports come down, then that's going to be a double whammy, and that's going to again increase the vulnerability that we already have on the external front. Sure, the fact that oil prices have come down, it does help, but ultimately if the global economy does poorly, in fact we've already seen the IMF cut global growth for this year, then in that case it's not good news at all. So, right now, Taneia, the fact is there's too much uncertainty and one really cannot say what's going to happen in global prices apart from the OPEC meet. Let's also remember that the sanctions, the waiver that we've got is only till the month of March 2019, and after that when you have somebody who's as unpredictable as Trump in the White House, one really cannot say. He's almost as volatile as oil prices.
Yeah, isn't he? Anand, let me just take off from where Maitli left. The IMF has warned of global growth becoming less balanced and sort of rising downside risks. Growth forecasts have also been cut for next year. So you've got rising trade tensions on one hand, the reversal of capital flows from emerging markets, tightening financial conditions led, of course, by the US Fed. So honestly, it's seeming like quite the heady cocktail. How are you assessing the risks that lie ahead for India?
Well, Taneia, as you said, it is a confusing cocktail. In fact, it's worth noting that the last time oil prices came down to $30 a barrel, our asset prices and our stock markets weren't necessarily doing well, because that was a time when global growth collapsed after the global financial crisis. What does tend to happen though is, because on a standalone basis lower oil prices clearly benefits us as a country, we tend to do better than other countries, if that is any comfort. But as I mentioned in the beginning, look, this is a huge hodgepodge of factors going through: oil prices, global growth, geopolitics, trade war between the US and China. US itself isn't doing too badly on growth, so maybe the Fed hikes still continue. All of these are exogenous factors which, your guess is as good as mine. We might as well toss a coin or look into the crystal ball to figure out where it's going. What we can control is our own domestic economy. And to your earlier point, we do have weaknesses beyond the external sector and exports and imports, particularly on the health of our financial services ecosystem and on our fiscal deficit. On our financial services ecosystem, there is a lack of capital amongst banks. NBFIs are not in great shape either and probably need capital as well. There is a feeling of distrust about the asset quality all around. All of that needs to be addressed as well, and that's something we should be working on as we go along. Likewise, on the fiscal side, while the government insists it will meet 3.3% fiscal deficit for this year, frankly, the math looks tough. Even though oil prices coming down should help us on all the macros, as the earlier panelists mentioned, the fiscal deficit for this year looks like slipping by 0.4 to 0.5% at least, given the slowdown in tax collections, given the fact that we are not meeting our disinvestment targets, and the fact that expenditure is going to be high in this election year as well. So we do have imbalances that we need to concentrate on. We can always play the forecasting game on what happens to global factors, but we would do far better to work on things that are within our control. And these three areas, the external sector, the health of our financial services ecosystem, and our fiscal health, all have lots of areas to actually address, and we should concentrate on that.
So look inwards more than, what's not in your control. Mr. Chandra, let me ask you, do you also expect, just like we are seeing Donald Trump do, the US, continuing to sort of push for a Goldilocks price range as far as crude prices are concerned? Because the fact is that it also doesn't want prices to be very low, that drives shale oil out of business, and not very high, because then that's going to stoke inflation.
Yes, the shale band is about $60 to $65. What we must not forget that crude oil has a global price. So if prices go up, pump prices in the US will also go up. Now, President Trump, after having lost the House of Representatives, would perhaps be very wary of displeasing his domestic constituency anymore. So my guess is that $60 odd, $65 is what he would like. Whether Saudi Arabia would play ball, whether Russia would play ball, or the fragile 5 countries, Libya, Nigeria, Venezuela, what happens to them is very difficult to predict. So things may spin out of control, but President Trump would perhaps like it around $60 plus minus 10%.
Okay. You know, Abhishek, the Saudis and other producers opened up the taps over the summer because the worry was that Trump's decision to reimpose sanctions on Iran threatened to take a large amount of oil off the market. Do you think they were just being overly proactive because the focus clearly doesn't seem to be Iran, anymore? And if I could just add to that, what do you think then, for the benefit of our viewers, would you say would be the key factors at play which will dictate oil prices over the, say, next 6 months or so?
Okay, that's a very interesting question. And at the time when Saudis decided the last move, it made sense because it was almost certain that those US sanctions will come into effect immediately once they are announced. But what actually happened was, after those sanctions came into effect in November, the second round of sanctions, then several of the consumers of Iranian oil, they were given an exemption. So that's part of the reason that drove oil prices low, and that also created quite a lot of tensions between Saudi Arabia and the US. What you'll see is that the current low prices, they are unlikely to last for a long time. So once those US sanctions, the waivers from them, they expire, you should see some support to oil prices then. I would say it's a temporary move.
Mightly, let's talk about, what possibly depressed crude prices could also mean for, the RBI's action. You talked about earlier on in the show about how you are seeing inflation, well within the RBI's comfort zone, so to speak, clubbed with the fact that it seems that oil might have made a bottom at least at, $60 a barrel for the near future. Given that, would you say that any sort of a rate hike, at least in December, is now completely ruled out?
Well, yes, I would not say completely because one can never be entirely sure. But if oil stays at this range roughly, then it will be very difficult for the RBI to justify any kind of rate action, particularly a rate hike, for the simple reason that we already have consumer price inflation at 3.3%. Now, if oil prices are low, then slightly the inflation numbers will slip even lower, in which case we already have real interest rate, which is the difference between the CPI. Of course, it should be forward looking CPI, but for simplicity's sake, if we take the existing CPI and the RBI's repo rate or the 1-year treasury bill rate, then the real interest rates are in the region of about 3.5 to 4%, which is already very high. In an economy which is not doing very well at the moment, economy seems to be recovering, but it's been in this mode for quite some time. So you really cannot afford to risk a rate hike. At the same time, there is a very real possibility, in fact, not a possibility, it's more or less a certainty that the Fed will hike interest rates. So it makes the RBI's position very difficult because it will not be able to justify a rate hike. And if it keeps interest rates at status quo, which is the only logical thing to do if oil prices stay at this range, then as I said, you have the possibility of an outflow, particularly from the debt front. So for the moment, if oil prices stay this rate, it's going to be difficult for the RBI to do any kind of rate hike, which in that case, as I said, does expose us to the risk of a capital outflow.
Is that a viewpoint, Ananth, that sort of resonates with you? How do you suppose the RBI is going to be tackling, multiple factors that are going to be at play?
Look, Taneia, the old thought process is never say never. But I do agree with Maithili. I think a rate hike is out of question in December for the reasons that she mentioned. CPI inflation has been extremely well behaved. In fact, has surprised on the downside even before oil prices corrected. And secondly, now the biggest threat that we had for inflation and the overall macros, which was oil prices, clearly has subsided. Now, in fact, I would suspect the market would start clamoring for the reverse, which is remove this calibrated tightening stance and maybe go towards trying to provide accommodation again, now that the macros seem to permit it. Let's not forget that we already have a somewhat stressed financial services ecosystem that's crying out for relief. So I wouldn't be surprised if the market starts clamoring for possibly even rate cuts, or at least higher amount of liquidity being provided into the system. I think on that front, the RBI probably ought to be a little careful. This is a very uncertain global context. We don't know which way things will swing over the course of the next few weeks and months. And multiple factors are at play, like we discussed earlier. It's not just oil prices, it's global growth, it's geopolitics, it's elections coming up and uncertainty around that, a whole host of issues. So given that, I think the RBI will probably stay pat, not do anything. But if oil prices continue to remain depressed and suppressed, and if the CPI inflation, particularly with food inflation being as low as it is, continues to surprise on the downside, eventually it will probably remove the need for calibrated tightening and go back to a neutral stance. At the moment, though, I expect the RBI to stay pat.
The government's been doing a good part of the heavy lifting in pump priming the economy. Private sector spending continues to remain weak. Given what now everyone seems to be suggesting, and that's the impending global slowdown, should we be expecting any sort of a recovery emerging in the private sector?
I hope there is a revival in the private sector. But one of the ingredients required for the investment cycle to restart is you need a strong financial services ecosystem which is able to fund investment and growth. At the moment, banks are short of capital. At the moment, NBFIs are degrowing rather than actually growing. Given that combination, frankly, it will take a lot for the private sector to start again. But yes, improving macros with low oil prices clearly help. One does hope that alongside the pump priming that, as you said, the government is doing, if we do get capital infusion into the financial sector, maybe then the ecosystem will be in a better shape to actually allow for an actual revival in the investment cycle that we so desperately require.
Right. Mr. Alag, I was actually asking you that question, but let me sort of ask you again, what about private sector investment? There are clear signs, or at least early signs of capacity utilization going up, but there continues to be a big hurdle of, banks' balance sheets that may not be able to aid private investment.
Well, private sector investment, I don't think it's going to be affected that much by the fall in the oil price. Generally, the private sector tends not to pass on the oil price decrease to the consumer. There, the real issue is whether public investment is going to pick up. Now, I think this does give government more free play to raise investment. That by itself should suck in private investment in a much bigger way. But you don't see that happening in 15 days, if you like. I mean, this is the kind of thing which I still think that if they really move fast, it is possible that before the next election, private investment and domestic consumption will go up. And this gives them the free play in the system. But they haven't been really taking those kinds of initiatives. And so one can only pray for them to seize this opportunity, as it were, and to move ahead by, actually the budget does provide for a fairly substantial increase in investment. But from all indications, that is not taking place. Now, this seems to be the time where they should call in everybody. Somewhere near this time, people are preparing for the next year's budget. Those preparations start in November. So they should use that to really push them to say, look, now go ahead. Between now and March, we expect you to perform. So that the big spending ministries, transport, other infrastructure, power, they should all be pushed to invest more, and then the private sector will respond. Normally the time lag is about 3 months or so. So if they start doing it now, most certainly before the elections, you should see a revival of the economy. I mean, unfortunately, agriculture has been doing poorly. That's because of the weather and other reasons. But otherwise, this could give the fillip if the government does come out with the program in the next 2 weeks or so.
Maitli, you know, while of course falling oil prices is great news for the economy and, you know, will help rein in the current account deficit, there are revenue side concerns that remain. We talked about how GST revenues are way off the mark. The divestment target maybe is a tall task. Given all of that, you know, even Anant alluded to the fact that 3.3% fiscal deficit target looks increasingly challenging. Would you agree?
Well, you know, the government always has means of ensuring at least the disinvestment target is covered. You can always have one PSU buy into another. So, there are all kind of fudges that are available. And even though the GST collection has not been that great, the fact is direct tax collections have improved quite dramatically. So, I wouldn't rule out the possibility of government reaching that 3.3% mark simply because the government has set so much store by it. It has been very proud of its fiscal record. So, even though the states perhaps have slipped and the overall deficit is not too good, I do expect the central government, the union government to stick to that 3.3%, whether through fudges or not, but I don't see too many slippages. And now particularly with oil prices falling, I think this is going to come as a big relief to the government. So, I don't see that really happening. And in fact, this would be good news in a way, because the government would be able to continue its spending, because private sector investment, I don't see it picking up, particularly because election uncertainties. I think every private sector entrepreneur would like to wait and see what the outcome of the elections is, and only then start investment. So, the good thing really is with the oil price fall is that government can perhaps continue to spend, and that is very necessary if the economic growth is continue to maintain the momentum that we are seeing, the slow momentum that we are seeing. That is very important. So, this I think is really welcome news, as I say again and again, provided of course it is here to stay, which of course is always a big if in the case of global prices of oil.
Yeah, absolutely. Anand, 3.3%, is it going to be sacrosanct?
Well, the finance minister has repeatedly assured us that he will meet 3.3%. But frankly, the math does look challenging, barring, of course, creative accounting of the kind that Maithili mentioned. Look, while I agree that direct taxes are looking better, overall tax collections at the center level across direct and indirect taxes for the first 6 months has only grown by 7.1%. And this is government website data. This is lower than nominal GDP growth and well below the 19% budgeted. So there is a shortfall as of now on overall tax collections. Likewise, on the disinvestment target, you know, 90,000 crores budgeted, only 10,000 crores raised so far. And this is not even considering all the expenditure side constraints that we have, including higher subsidies on LPG and kerosene, because budgeted cost, the oil prices are lower than where the actual oil prices have turned out to be. So there are pressures on all counts. I do see a slippage coming through, and it's very, very difficult to see how it can be avoided. But yes, we have ways in which that can be managed at a headline level. First of all, India continues to have cash accounting for its budget, which means postponing refunds or, you know, pushing expenditures into the next year would artificially make this year's budget numbers look better. Likewise, on disinvestment, you know, last year we had HPCL, BPCL. This year there's talk of REC, PFC, some jugglery. Left pocket, right pocket, that can generate some money as far as revenues are concerned. But most analysts would tend to look through those kind of managements. I do think we have to start addressing the quality of our fisc on a more medium-term basis. It's an election year. Nobody is going to scream too much. We all understand there are pressures that you have to manage. At the same time, I think overall the fisc across state and the center does have weaknesses which need to be addressed over time.
You know, I have time for just two last questions, and Mr. Chandra, I'm going to sort of end off with where we started, that was crude oil prices. And, you know, as you yourself sort of talked about how, it's a story that also points to the bigger issues, the fact that as a country we're yet to fix up, strategic sourcing of oil at the cheapest prices that are available. We've done perhaps not much to address our refineries that require revamping as well. If I were to just ask you what you think, are some of those maybe easily tackleable issues, looking at the bigger picture, what would you say would be the priority for the government?
One, we have to look at the demand. And the demand, as I mentioned earlier, the huge amount of diesel which is being consumed by captive diesel gensets, that is something which can be done away with, provided the governance issues around distribution companies are sorted out.
Okay, I think we've lost Mr. Chandra's audio there. We'll try and get him back for you. But, Abhishek is with us as well. And, Abhishek, as we speak, after you had oil prices sort of nosediving 7%, we're seeing a lot of that recovery being made. So, of course, it's anybody's guess which way it's headed. But, if you were to just, again, outline for us over the next couple of weeks, what are some of the key triggers and factors at play for the oil markets, what would you sort of detail?
I would say the most important factor over the coming weeks will be the OPEC meeting and what they decide, whether they decide to cut or not. And that will have a very big impact on oil prices. And the second big factor, I would say, the waivers from the sanctions on Iran. So once they expire, then how far they push prices higher. So those are the key factors for me in the short term.
Mr. Chandra, very quickly, if my voice is reaching you, I'm afraid you were cut off. Please go ahead and finish the point you were making.
The other thing that I was saying was, adding to what the previous panelist said, driving Iran into a corner is not a very good idea. If you knock out about 2 million barrels per day, China, of course, would buy from Iran, but a massive reduction, the loss in revenue, the internal distress that would be caused in Iran could be very destabilizing for West Asia. The other factor is the agreement that US had with the House of Saud in 1976, where they assured protection to the House of Saud from Iran, from Israel, from its internal dissenters. And in lieu of that, the House of Saud said, look, we'll give you as much crude oil as you want, and we'll only sell it in petrodollars. Now, given that agreement, President Trump is in a position to exert great pressure. So the interplay of these factors would be evident in the OPEC meeting, and that is when we will know whether the prices would stay stable or move northwards.
That one, I'm afraid we're completely out of time, but Anant Narayan, Saurabh Chandra, Maithili Pusturmat, YK Alag and Abhishek Kumar, thank you so much, each one of you, for sparing the time to chat with us here on the India Development Debate.